And welcome everyone to a mid-year client update. And we've got a lot to talk about today, and brought in the heavyweights to help get our message across. Over the last year, there's been plenty of things to worry about, starting last year with the war in Ukraine that came out of nowhere, and then oil prices shot higher. Inflation went through the roof. The Federal Reserve decided to do something about inflation and started raising interest rates sky high in a very short period of time. And then, of course, this year we've had some banking issues. A couple of big banks went belly up real fast, adding some more worries to the markets. And so I guess basically nothing new here. We've seen all this before. We've been through it many times over the decades. There have been bank failures, there've been crises and oil spikes, and even debt ceiling negotiations that went on and on forever. So we do have a lot to talk about. We'd certainly like to answer your questions as we get to the end of it. But we are going to update you on our current thinking, and I hope you enjoy it. First, I'm going to have to go through a disclaimer page, which our legal folks want us to share. And it's part of keeping our lawyers happy. So just read this real fast, and we'll move on to our next slide here, which is today's agenda. And we've broken it down into 4 different segments here. Our favorite financial planner, Pamela, is going to start off with some tax-savvy tips to save on taxes, but also to help with any charitable giving objectives that you might have. And then Joe's going to cover the Pring Turner process, what we do, what we've been doing since 1977. And some of that material, I think I first started teaching classes with Joe in the early 80s, and some of that material I remember from way back then. It's the same material, just a different format. We're using PowerPoint instead of a chalkboard, but it's still valid today, just as it was back then. And then after Joe, we're going to have Martin give us an update on what he's seeing in his business cycle research and some of the opportunities that are popping up. So, that will be an important update on the business cycle side. And then Jim and I will wrap up with taking that information and reviewing what we're doing in portfolios and what that means for you, and maybe what to expect going forward here for the rest of the year. Finally, we'll do a question and answer with all of you. But I'm going to turn it over to our financial planner, Pamela. Take it from there.
Yeah, thank you so much, Tom. And thanks to all of you who are joining us today live, and to anyone who is listening to the recording. Hi, and thanks for being here. I do want to actually quickly, just for a little housekeeping business, let you know that at the very end of the webinar, there will be a quick survey. We would greatly appreciate your feedback on that survey. It is fully anonymous. It really helps us learn from you and do better with every single client event that we have. As well, along the way, if you look at your screen, your participant screen, you can see that there is a Q&A tab. If you have any questions that pop up along the way that you just want to ask and enter in physically there, feel free to, and we'd be happy to answer that at the very end. Well, all right. So thank you so much, Tom, for the little introduction there. And I'm excited to talk a little bit about one of the questions we get quite often from clients, especially in the past couple months, is how can I lower my taxes? What are the strategies available to me? Today, there's a dozen different types of strategies, and some of them can be incredibly unique to your situation. Some of them anyone can use. Today, I'm going to focus on 3 unique strategies, and as they specifically relate to charitable giving. So the 3 I'm going to talk about is how giving directly to charities, qualified charities, outright can be beneficial. I'm going to briefly introduce donor advised funds as a really excellent tool. And then I'll also give an example as to how qualified charitable distributions from a retirement account is, and potentially, or can be potentially, a really helpful tool. So first, when you give to charities outright, to qualified charitable organizations directly, you can possibly receive a tax benefit if you itemize your deductions. So the benefit can differ though between the type of assets that you are gifting. So for example, if you give cash, you could receive potentially up to a deduction of 60% of your adjusted gross income. Moving forward, for short, I'm going to call it AGI. If you give stock, you could potentially receive up to a 30% deduction of your AGI for appreciated stock that you've held for over a year. And the benefit of also giving that appreciated stock is that you can hopefully avoid that capital gains tax as well. So that's just a direct, simple way that anyone really can utilize if you itemize your deduction. But that said, there are other options available to you that some of our clients have used and used quite favorably for their situation that we want to also let others be well aware of, depending on whether or not it works for your unique situation. So the first of them is the donor advised fund. These are becoming increasingly popular. There's over 1 million of them now opened within the United States alone. They are a simple, tax smart investment solution. You can kind of consider them as the quarterback of a charitable donation and philanthropic account / tax saving opportunity. And the good news is that Charles Schwab has a separate wing that's called Schwab Charitable. And you can open a donor advised fund account with Charles Schwab Charitable, which is quite handy. Now, what is a donor advised fund? Kind of what are the basics of it? So how do these work? First, you would open your donor advised fund, potentially with Charles Schwab Charitable, and then you would donate either cash, stocks, or other assets into it. For assets such as stock or real estate, for example, you would receive an immediate deduction in the year of contribution of those assets for their fair market value, and potentially eliminate that capital gains tax as well. The third step would then be, as the assets are within your fund, you can grow them tax-free for as long as you wish. We at Pring Turner, we do actively manage other clients' donor advised funds, the assets within them. We'd be more than happy to have that conversation with you if that's of interest. But of course, Schwab, for example, Schwab Charitable does have passive investment options available if that's also a preference of yours. And then from there, you actually have the flexibility to choose which charities you gift to and when. There is no restriction, like I said, for how long the assets can remain in the fund and grow tax-free and before you gift. So longevity and flexibility are key components of these types of accounts, which makes them incredibly attractive. And the third and final giving strategy that I was going to talk about today are qualified charitable distributions. That's a big word. I'm just going to use QCD moving forward. So in short, these are amazing ways to reduce your adjusted gross income, or again, as an acronym, AGI. So it's a way to reduce your AGI while also satisfying your required minimum distribution. For those who are not aware of what required minimum distribution is, or RMD, currently, as of 2023, when you turn 73, you are required to withdraw a certain amount from your retirement account every single year. This is known as the RMD. The thing about retirement account distributions, though, is that any amount that you distribute from that account is taxable income to you. Except that's where QCDs come in as a potentially really useful tool. And I'm going to show you how it's a useful tool using an example from actually Charles Schwab Charitable. So we're going to use Bob. Bob is the example. He is a retiree. He is of RMD age. His AGI for the year is 80,000. When he takes his RMD, that brings up his adjusted AGI to a little over 122,000. Now, he doesn't really need all the money. He wants to attribute his RMD amount to charity, both because it makes him feel good, but also because he'd love to receive a little bit of a tax reduction. So he's going to give his RMD, once he withdraws it from his retirement account, to charity. That allows him, as it's way larger than his standard deduction, he can use that as an itemized deduction come tax filing time, which would result in an estimated taxable income of $80,000. Now, that's when he withdrew his R&D from his account, put the cash into a personal account, and then gifted to charity. But QCDs allow you to gift directly from your retirement account to the charity without triggering a taxable event to you. And I'll show you what that looks like. So Bob's AGI is $80,000. He then gifts to the charity directly from his IRA. He gifts his total R&D amount, allowing him to still utilize his standard deduction of a little over $15,000, resulting in an adjusted taxable income of $64,300. So by utilizing the QCD while still giving the same amount to charity, he reduced his taxable income in this example by $15,700. So you can see how this type of strategy can be useful and when employed strategically. Now, I know I just gave you a ton of, for some people, it may be totally new information. So if you have any questions related to your personal circumstances, if you want to talk and are interested in learning more about these vehicles, you want to, talk more about other strategies that might be available to you, feel free to give us a nudge at any time. We would be more than happy to walk you through that process and learn more about your goals and how we can help. But with that being said, I am now going to pass the mic on over to Joe, and he is going to talk about the importance of process and also offer a bond market review.
Thank you, Pamela. Just to tie in the discussion that Pamela had with portfolios and wealth, one of the things that I love about our profession is, and I've had a 50-year front row seat to see the good that wealth provides and how wealth can be used through charitable gifting to benefit society enormously. And I mean, I've just seen some wonderful things. I could go on for hours, but that's what wealth can do, and that's why I'm really proud to be associated in this profession. So let's talk about wealth. What my agenda is today is I have threefold. Usually, I'm the star of these podcasts, and I normally have given an hour or 2 hours to talk, and for some reason the team has cut me back to just 5 or 10 minutes. So I'm going to talk really fast, and maybe you have to listen really fast, but these are the things I'd like to cover in the agenda. As Pamela said, it is all about process. It's about the investment process. And I'm also going to touch on what is new in the financial markets and the environment out there that affects your portfolio and things that we are doing in your portfolios to take advantage. And the third thing that I'm going to discuss is the bond market, where finally, after a number of years, we have both income and the possibility of growth. So those are the three things that I'm going to cover. I want to step back just a little bit. I start my day every morning. I grab my cup of coffee, I go out onto the deck, and I have the world to myself, at least the thinking world. And one of the things I like to do is go into gratitude. What are the things that I'm, really grateful for in my life? And one of the things recently that has popped up as a word has been process. And by process, the simple definition is it's just a series of actions, changes, or functions that are used to achieve a result. And let me tell you a story. I'd like to tell a story here of where this really jumped out at me, and I'm going to take you back to 1981, when as a new and struggling investment advisor, I was invited to give a presentation of how we invested to a corporation, and with the idea that I would be managing the company retirement plan. And I was invited in. The chief financial officer that I spoke to interviewed me. I made my presentation, I could tell he was a sharp cookie. He asked a lot of pointed questions. I gave my talk. I didn't know if I had gone over well or not, but I did get a call back a few days later, and now I was asked to give that same presentation to the investment committee for the company, which I did, waited another couple of days, and lo and behold, I got my first corporate retirement account. And I was very excited about that. And a couple of months later, I asked that chief financial officer who interviewed me why I was selected. And he said, for two reasons. He said, one, your conservative philosophy, and two, the process that you use to make decisions. And he related back his story, which was in 1973-74, we'd gone through a vicious bear market. He said, I was a chief financial officer for a company, and I had to stand in front of all those employees and explain to them that they had just lost 50% of their retirement funds. And he said, I never want to do that again, ever again. So he said, the philosophy and the way you made decisions and constructed portfolios is what your process is what swung me over. So what is the Pring Turner process? It's simply a disciplined decision-making process that we have that is designed to make changes in your portfolio around the business cycle and how that progresses through its various growth or slowdown phases. And as in the definition of process, what we're trying to achieve and our goal is to protect and grow your valuable assets. So what does this look like? The investment process starts with looking at the business cycle. What does it typically look like? And to simplify this, we're looking at the economy where the left side, it starts growing, it gets stronger, it accelerates up, then it matures, it slows down, it rolls over and starts the slippery slope to the downside. But on the upside, business is looking good, employers are hiring people, the workforce is expanding, profits are growing, revenues are growing, everything looks good. And on the downside, we usually head towards a recession. And this situation, this picture that you see has repeated itself over and over and over again. We are currently in business cycle number 35 as we measure back to the mid-1850s. So this is what we use to frame our decisions for you and how we construct portfolios for you. And what economists have come up with is a description of leading, coincident, and lagging indicators relative to the economy. And one of the leading indicators that falls into that category is the stock market. So the stock market typically leads the economy 6 to 12 months ahead of time. It makes it difficult sometimes when the economy is day after day giving black news about how bad things are, and we start buying. But that's what the normal sequence is. The stock market will see the end or smell the end of the recession, and it'll start going up. So this is the relationship of one of the leading indicators, and this helps us determine how to manage risk versus reward. There's another category of indicators. So the stock market's leading, the economy is the coincident indicator, and then we have another group of indicators that lag the economy, and that typically would be things like inflation. Interest rates will lag the economy. So these are things this is what we look at, and this is how we evaluate risk and reward. And for us, when you put it all together, and we build models to tell us where are we in the stock market cycle, what's the bond market look like, is it a low risk, good opportunity or not? And when we put it all together, we get information from the models that help us allocate your assets to the best risk-reward profile that we can come up with. It will tell us what assets to favor or not. It tells us whether we want to play offense or defense. what sort of, do we want to drive the portfolio fast? Do we want to drive it slower? What sectors to emphasize at different points in time? And even what factors work best within this whole framework. So the beauty about business cycles, they do repeat. As Martin pointed out many years ago, the great part about business cycles is they're rational, they're sequential, and logical. So, and one business cycle leads to the next business cycle. So that's the process that we have used to overlay, to make decisions in portfolios. And it's the same process that we've used for 46 years. And the same process that chief financial officer saw that made him comfortable and confident that he would not go through another meat grinder. We've honed it, we've improved it a little bit over the years, but it's the same basic process. So with that, let me shift gears a little bit, and my second topic is what's new. And sometimes we like to say, we talk about the good old days. Well, in terms of interest rates, which is the chart that you're looking at, across the bottom axis, we have time, starting from 1 month out to 30 years. And on the vertical axis, we have what interest rates we were able to get or what the market provided at any point in time. So a hint here, we do not want to return to the good old days, at least not as investors, because if you look at this graph, there was no return, there was no interest return on anything for this period of time that I've selected, which is July of 2020. This was the historic low in the entire interest rate cycles. You lived through a historical point in time where you experienced the lowest interest rates in history. Let's move forward a little bit to March of 2022, and now notice that interest rates have started moving up slightly. The reason I took March 15th is this is the day before the Federal Reserve started and began a series of interest rate hikes because they needed to slow down inflation, which had become a problem. So now we start on this journey where interest rates go higher and higher and higher, and look at where we are today. And this is the opportunity, and this is truly what we see in returns that you can get. And if you look at the 1 month, 6 month, the 1 year, north of 5% returns. And if you look at it 2 year, 3 year, compared to where we were 2.5 years ago, incredible opportunities to get higher returns, higher income returns on almost any instrument out there. So that's what's new. This is something where finally as investors, we can start getting some sort of decent return on money markets, on investments, on deposits, and short-term instruments. And finally, what we have seen improvement here is in the bond market. I mentioned that we build models. What you're seeing here is on the bottom is what we call a bond barometer. It is a model that we have developed, Martin's developed, that attempts to capture the favorable times to own bonds and to avoid the bad times. So the barometer, anytime that's above 50, you see a green marking in the upper chart, and that is just simply the price of a 20-year bond. And you can see that back in 1920, 21, green turned to red. And that told us probably not a good time to own bonds. So looking at our business cycle, it's like, okay, let's sidestep that. And sure enough, bonds dropped 35, 40% during that period of time. So a good time to avoid bonds. Look what's happened here recently. It's hard to see, but we have a little green mark at the end of that chart. And that's because down below, the bond barometer, which has been negative, telling us to avoid bonds for the last 2.5 years, has finally gone positive. So now we have this opportunity not only to get better income than we've had in many years, we also have the opportunity to get profits from bonds. And we expect to see a green mark that moves up that will be profits or capital gains that we get from bonds. So that's my story, folks, and I'm sticking to it. So just briefly and in summary, what we have here, the process, it's all of the decision-making process is all about following the business cycle, analyzing where we are and what we want to do. And the beauty is we just keep doing this business cycle routine over and over and over again. The other thing that I touched on, what's new, is we finally have a return from interest. Actually, this is the best returns we can get on short-term interest rate items since before 2007 when we had the great financial recession. And then lastly, bonds, based upon our disciplines, are giving us the opportunity not only for income, but we expect to have to see potential growth in capital gains from bonds in the foreseeable future. So that's it. And with that, I'm going to turn the mic over to Martin and let him dig deeper into the business cycle.
Thank you, Joe. I'm going to piggyback a little bit on what Joe said earlier. And that was the idea that the stock market leads the economy, which in turn leads interest rates and inflation. In this diagram here, we're looking at the economic growth path and its relationship to the primary trend peaks and troughs of the three financial markets. These are bonds, that's the letter B, stocks for S, and C represents commodities. As you can see, they go through a definite chronological sequence as we move through the cycle. And the cycle continually repeats, and it repeats on an average about every 41 months. Because while this is the growth path of the economy, sometimes the economy comes down into a recession, and sometimes the down part of the economic cycle just takes the growth curve down towards zero. That's what we call a growth recession. So allowing for all those growth recessions and all those recessions since the 1960s, it's averaged about 41 months between trough and trough, sometimes more, sometimes obviously less. But the whole thing about the business cycle is like the calendar year. The calendar year goes through seasons, and there's a certain time in the year when you want to be planting if you're a farmer, and a certain time that you want to be harvesting. Well, the same thing is true in a business cycle. There's a certain time in the cycle when you want to be buying bonds, and a certain time when you want to be buying stocks. Sometimes you want to buy both. Sometimes you want to buy commodities as well. And there's a certain time in the cycle when you don't want to own anything to speak of, or you want to lower your risk. So, for example, if you look at the bonds, they're bullish, and I should point out that these rectangles here represent stages in the economy from 1 to 6. So it starts off in stage 1, and bonds stay bullish all the way until stage 4. So for 1, 2, and 3, they're bullish, and after that, they're bearish. So that's a period in the cycle when you want to be emphasizing bonds. And each cycle in its makeup is, of course, different from all the others, but they have a lot of common threads that run through them. For stocks, they're bullish between stages 2, 3, and 4, and commodities between 3, 4, and 5. And then in stage 6, you want to be taking a very defensive attitude towards investments. Question is, where are we in the cycle? Well, we have, like Joe was alluding to, we have models that help us do this. And Joe showed you the bond barometer. So that's giving us a clue as to where we are right now, because bonds are bullish between stages 1, 2, and 3. So the question is, which of these 3 stages are we at? We believe that we're at stage 2, which is bullish for bonds, bullish for stocks, not so hot for commodities at this point. And I've got some indicators that are going to help show that. So let's move on and take a look at our first indicator, which is our stock barometer, which is composed of 6 different components. And when it moves above 50%, that's when we get one of these green highlights here. And the red highlights indicate when we're at below 50%, 49% or lower. And that's, as you can see from the chart, it's been very good in terms of keeping us into these big bull markets. But more importantly, managing risk keeps us out of these devastating bear trends, or doesn't necessarily keep us out, but tells us to lower our allocation towards stocks. Where it can be faulted is in a situation where we have an ongoing bull market and a little mini bear market, like one of those growth recessions I mentioned, and then at an abundance of caution, it goes bearish. And I think that's the one thing that we can fault this model on. On the other hand, when it goes bullish, there are very few examples of false bullish signals. There's one in this bear market here in 1982, and then one over here in 2015, 2016. But by and large, when you get a bullish signal, it means what it says. And we have a bullish signal right now for the last 3 weeks. So that places us in terms of our barometers and models into a stage 2. Before I go back I can move on to the next slide. I'm going to move back to this one I showed you before, because I want to talk a little bit more about stage 2. In stage 2, stocks bottom and commodities are still going through a negative trend, a bear market. So if stocks are bottomed and commodities are coming down, the ratio between stocks and commodities should be moving up in favor of stocks. And that's what we're going to show in the next chart, because I showed you this chart at our last webinar, and I told you to watch out for this indicator here, which is the stock commodity ratio, but it's not the actual ratio, it's the momentum. So there's lots of oscillations going on here, and it's very cyclical. It's got a great cyclical rhythm to it. That's why I like it. So anyway, it was below 0 and falling last time we showed it to you, and that was back in last fall. But when it starts to turn up, you can see from each of these arrows here, you look to the right-hand part of the tip of the arrow, numerous signals, all followed by higher stock prices. And these are inflation adjusted too, so that makes it even better signal. There's one false signal down here in 1978 when it kind of went sideways and up and then down into the 81, 82 bear market. But that's about the only exception since this chart began in 1940. The first signal was triggered in 42, 43. So it's been a consistent indicator over the years. We mentioned, of course, that the stock market is tied into the economy, and the stock market leads the economy. So what we do here is we take the G7 leading economic indicator published by the OECD, and we turn it into a momentum indicator, which gives us a slight edge on all the turning points. And of course, it again gives us some cyclical rhythm to it, and also tells us when the economy is down to the kind of level when we would expect to have it turn up again. So what I can do is first of all, I should point out that these red highlights represent recessions. And when we get the buy signals, which occur but with the momentum crossing above their 6-month moving average from at or below the green horizontal line, that's when we get one of these arrows. And if you look to the right of the arrow, you'll see that either that's the last part of the recession, or it's starting, or the recession is over. So it's a pretty consistent indicator going back, in this case, back to 1960. And we, excuse me, let me grab some water here. So the solid arrows show reversals are usually associated with the end of a recession. And we can also find some buy signals that occur as well that are occurring from or at or below the green line, not associated with a recession, but also providing great buying opportunities for stocks. There was one indication that was not good, and that was the end of the 2001 recession, when the stock market was busy unwinding from the tech bubble. So even though the economy recovered, and this indicator was giving us an accurate signal, it was not followed by a bear market. That's the first time that there's been a disconnect between the stock market and the economy since the late 1920s, when there was a recession, and because of the strong stock bull market between 21 and 1929, the market refused to correct. So usually it pays to go with what the economy is saying. So long story short, if you see here in the latest periods, this indicator started to turn up about 4 or 5 months ago and is in a solid bullish mode right now. And I got the data for May earlier in the week, and that is also enabling this indicator to continue to move up. This is only plotted up to the end of May, and it doesn't include the actual May data. So it's still, the recovery is still underway here. Finally, I'd like to show you a technical indicator. This is what I call the 1, 2, 3 technique, because it involves 3 things, and it's easy. It's as easy as 1, 2, 3. The first part is that the 12-month rate of change, which is what this is, drops below 0. Drops below -5%. Number 2, it goes back above 0. And Jim had a great analogy for this, I thought, and he was saying it's kind of like having a beach ball in a swimming pool, where the green line here represents the water level, and you push the beach ball down below the water and then release it. It rushes straight up to the water, and once it passes the water, it explodes. So the third part of this is wait for those stocks to rally. And we got a buy signal a month ago, and that was the 39th signal since 1900. And the previous 38 signals, if you'd held on for 6 months, gave you a return of 8.5% compared to the average holding period of 6 months from 1900 to 2023 of 3.5%. So it was twice what the buy and hold approach would have taken. And if you look at the annual return, it was 14% compared to 7%. So those are pretty good odds as far as I'm concerned. It's a great place to turn over. Talking of Jim and Tom. Thank you, guys.
I've got to unmute myself. Thanks, Martin, Joe, Pamela. So our job is to take that big picture information that Joe and Martin covered here in the first couple sections and incorporate that into how we manage investment portfolios, how we make decisions on a day-to-day basis. I guess if I'd summarize Joe's talk in simple terms, rates have moved pretty high thanks to the Federal Reserve in the last year. And for the first time in a long time, there's actually a bond market opportunity where we can lock in some income and also see some appreciation potential. And on Martin's side, things are improving on the stock barometer side. So there's a stock market opportunity. So does that mean we're just going to load up portfolios and just go to town buying bonds, buying stocks willy-nilly? Well, probably not. We're just going to take our time. We're going to move in gradual steps. Markets don't go straight up or straight down. But what we will be doing is, as long as these indicators stay positive, is we'll be taking advantage of opportunities as they present themselves to become more fully invested. And that's a distinct change from what we were doing a year ago. And I wanted to just maybe go back in time about the last 18 months. It's been a busy period. There's actually been quite a few barometer changes and stage changes. It hasn't been just quiet on the front here. It's been quite busy. 2022 started in growth mode for our barometers, and but with that Ukraine invasion and inflation kicking up and the Fed ratcheting rates up, we pretty quickly moved into the caution zone and then eventually into the protect mode. We sold stocks. We took advantage of the pricing and took some profits, reduced the stock market exposure in portfolios, raised the cash levels, especially with cash actually beginning to pay a decent income. And as the year went on, we wanted to add the short-term treasury notes to boost the income in portfolios as interest rates went up. And they also act to stabilize portfolios when there's stock market volatility. So, in other words, 2022 was a period where we went to a defensive mode and protect mode, and your portfolios held up very, very well. It was really the worst year for stocks and bonds combined since at least 1976. So just a typical passive portfolio that was 60% in stocks, 40% in bonds, probably saw double-digit declines in portfolio values. And, our typical managed account, certainly nowhere, much smaller declines, and very easy for us to get back to new all-time highs here in this next good period. If you remember, we had a newsletter in January where we mapped out the different returns in the different asset classes last year. The S&P 500 was down about 20%. The NASDAQ, which had all the growth stocks, was down over 30%. And even the bond side, the aggregate bond index, was down over 12%. And that includes dividends and income. So very rough year, no matter what asset class you were in. So we're pretty proud, actually, of holding our own in a very challenging year. And I guess that probably is the best example of the Pring Turner process. It's a flexible one. It's the process in action. We went from an offensive plan to a defensive plan, and now we're preparing for more offense here. And the barometer work has definitely started to improve, and we are basically back in a wealth building stage for the time being. And until the barometers change in a negative way, we're gonna stay with that approach. Like the next slide will do another job of just explaining, the difference between 2022 and where we're at now. This left side of the screen is winter, right side spring, and Martin was talking about the financial seasons, and we all know the calendar year has its own 4 seasons. Well, Martin's broken down the financial world into 6 seasons. In fact, he wrote a book back in the early 90s called The All-Season Investor. That was a very popular book that helped to really define the Pring Turner process for the first time. But last year, we were in defense mode, the lowering stock allocations, fixed income side of the portfolio couldn't earn very much, money market funds couldn't earn very much, and the overall portfolio yield was closer to 1.5%. But as we moved to offense this year, we're increasing our stock allocations. The fixed income opportunities were in the 4% area for quality treasury type yield, and the overall portfolio yields have bounced up to 3% or more. So that's great. We want to have yield in the portfolio. We can wait for the portfolio to grow or stock market to do well. And while we're waiting, we're at least capturing a 3% return. That cash flow just keeps coming in, day out. Whether the market goes up or the market goes down, that's a nice cushion in the portfolio. And then just getting a 3, 4, 5% added growth onto that from stocks or bonds will help give us a great total return with the least amount of risk possible. So basically, that kind of gives you an idea where we were and where we are. And Jim's going to take it the next step to go over a couple of areas that we see opportunity.
Thanks, Tom. And before I get into my slides, I want to kind of dovetail off of what Joe was talking about in terms of his process that he was talking about in the early 80s. Well, I'm in the office here, and I actually found his process, his pitch book, his old laminated slides. And as you can see, probably can't see it too well. It's too bright, but it was the same exact process that we had done. It's just laminated in hardcover as opposed to a nice digital format. And also happy to say that that client is still a client today, and we were just speaking with them here recently. So it's amazing how the last 46 years used the same process, and 46 years from now, they'll probably be using the same one as well. So I am going to talk about, I know why I'm talking about this section. I'm very qualified to talk about it. It's a very sophisticated topic, and it is a teeter-totter. I'm qualified to speak about that because I have 4 children under the age of 8, and I have lots of experience with teeter-totters. The kid gets on one side of the teeter-totter, I'm on the other side, and if I go up, they go down. If they go up, I go down. It's a very simple process, and it's actually all you need to know about how bond prices work. It's a very similar mechanism. In fact, you would have on one side of the teeter-totter, you have the level of interest rates. And on the other side of the teeter-totter, you would have the price of the bond. And they move opposite each other. And you might be thinking, well, why would that be the case? Why would if interest rates move down, would the price of the bond move up? Well, an easy way to think about it is if you were buying a bond and say the interest rate, you could buy an interest rate that's 2.5% bond, or you could buy a 3.5% paying bond. Which one would you rather own? You'd rather own, I'm going to guess, we all have very intelligent clients here, that you would want the one that's paying you 3.5%, not 2.5%. So if it has a higher rate of return and the market rates go down, then the value of that bond will go up. And in this example here, we use a 10-year, say you buy a 10-year bond and the interest rate goes from 3.5% to 2.5%, you would get an 8% appreciation in the value of your bond on top of the 3.5% interest that you would receive. So double-digit price return potential in that sort of an example. So interest rates have had a huge effect on the prices of bonds. The other thing I'd like to add is that the longer your maturity of your bond, the longer maturity of your investment, the more affected they are by interest rates. It's almost like the teeter-totter gets even longer and longer and longer, the longer the maturity of your investment. And this affects not only bonds, but all investment assets are affected, whether it's real estate property or stock, the stock market as well. Those are actually, we have one company, we have a railroad company in our client portfolio that has paid dividends for 122 straight years. So think about the maturity on that asset. If interest rates go up dramatically like they did, the value, the price of that company is going to be affected. So that's the first concept that I wanted to get into with you today in terms of bond prices. And that rise in interest rates has created an opportunity. It's better bond pricing, but it's also creating another opportunity that we think in another asset class, which is international stocks. The green line here, it goes back to the year 2020, so 20 years of returns. The green line is international stocks excluding the United States, and the blue line is the S&P 500, which is a large cap US stock index. And as you can see over time, the US stocks have outperformed international stocks. There was a time frame where the green line was ahead of the blue line, and then they quickly switched roles here shortly after the financial crisis, and US stocks have outperformed. And so one thing that we look at is not only is it important to what asset you're buying, but what price are you paying for that asset? And below here, I'm going to uncover what the relative valuation is of these two investments. So what is the price that you have to pay for a US stock versus the price you have to pay for an international stock? And as you can see, that has trended downward quite dramatically here over the last 15 years. To a point here, this blue line kind of shows if it was even, if it's at that ratio of 1, it means you'd be paying the same price for a US stock versus an international stock. You can see we're significantly below that line now. So it's showing us that the relative valuations of international stocks are more attractive than US stocks at the moment. So it's an area that we've added a little bit of exposure to. The other thing I'd like to add is that we really did not own international stocks for a very long time in accounts. Just recently, we started to dip our toes in a little bit, but this is an area where we expect potentially to add more over time and could be a really good value opportunity. The other thing is it does add additional diversification, just owning stocks in different countries and with different currencies does add some diversification as well. Final thing I'd like to cover is how we like to think about portfolios for many and having many different layers of protection. We like to think, Joe's always called the Pring Turner portfolio like an onion, and at the core are our client portfolios, and outside of the core we have many different layers of protection. Martin and Joe went into great detail about our investment barometers and our business cycle analysis and that layer of protection that we have. There's times where we want to plant and times when we want to prune. So that's a major part of the protection that we have. But a second layer or additional layers of protection that we have are not just when we want to buy or when we want to sell, but also what do we want to buy? And that's a very important question as well that you want to have answered. And we really have three main characteristics that we look for. Is we want to emphasize really high quality investments. We want to invest in the best companies. And we want to seek value. We don't want to overpay for these companies, even if this company is the next greatest thing or currently the greatest thing. A lot of the times those stocks are very highly priced, and we won't just buy them just because they're great companies. We want to buy them at a fair price. And the final thing is we like to have growing income. So if you buy a really high quality company and you pay a reasonable price, a lot of the time those companies will be generating extra cash, more cash than what's needed to actually run their business. And so what they can do with those is pay out dividends to shareholders over time. And ideally, in a great scenario, not only do they pay a dividend, but they consistently grow the dividend year after year. So we get paid while we wait. And it makes it a lot easier, especially as you're going through bear markets, to have that extra shock absorber there. So just to kind of wrap things up here, we're remaining cautiously optimistic. Things are starting to improve. We've taken lots of steps here so far this year. The income situation is improving. And I hope we've showed that we have a really time-tested and flexible investment process, which is unique. And, you know, in this business, nothing can guarantee success. You can't have guaranteed results. But if you do have a wonderful process and an amazing team, and third and foremost, most importantly, wonderful clients that are loyal and can stick with you through the ups and downs of the markets, that allows you to really put the odds in your favor of success. And so before I hand it over for questions and answers, we'd just like to thank all of you for your confidence and trust that you place with us. And, look forward here to, we appreciate the fact that we couldn't do what we do if it were not for all of you. So thank you.
Yeah, thank you so much, Tom, Jim, Martin, Joe. Really, really appreciate everyone chiming in with such great information. For anyone who's still with us here, you're welcome to post in a question in the Q&A section or in the chat section. You can make it private and simply say that you want to share it with the panelists here today. Now, I do have a couple questions before more come in. And so the way we're going to handle the Q&A is I will just ask client questions openly, and then anyone on the team can chime in and we can have a conversation and go from there. I'm going to start with the first question here. How useful is it to watch the news for updates on the economy? Do you recommend watching daily, weekly, monthly? Who wants to take that one?
I'll take a stab at it at first. Yeah, unfortunately, the news can be a little misleading. It tends to be negative, slant most of the time. And they're also, the news happens to be coincident indicators, what's happening right now. And oftentimes it's lagging indicators. It's like the report for the GDP came in at such and such. Well, that was last quarter. stock market looks out 2 or 3 quarters ahead. So it's not really helpful to know what happened last quarter. It's where we're going to be 2 or 3 quarters from now. So I think just keeping in mind, there is so much information out there. Part of our job is to gather. We read a lot. We pay attention to a lot of things. We filter out 90 to 95% of the stuff we see because most of it is garbage. But the other 5%, 10% is really good information. And, that's our job. We love doing that. We love watching the news, reading, doing research, and paying attention. We do that for you. But yeah, I don't know about this watching the news daily. Joe, what do you think?
I would say it's probably dangerous to watch the daily news and to absorb it unless you had a thorough understanding of the leading coincident and lagging indicators so that you could place, the importance. Well, is that important or not? Or is that something that's, not relevant and it's backward looking or whatever? So I think it's dangerous because the media tends to hype and, sensationalize things that happen. I mean, they're trying to get your attention. They want you to, to watch. So I think there's a lot more sensationalism in news. But if you understood these relationships, yes, then I would watch it. Other than that, turn it off.
Let us do that.
Perfect.
Yes.
Awesome. Good responses. Thank you. Another great question. Any thoughts on how the supposed emergence of artificial intelligence will impact the markets and investing going forward? Good question.
I'll jump in first on that one, Pamela. I think it could be like the internet in terms of its importance. And there's a possibility where you get, I don't know if we remember when the internet came about, it was a big deal, but you had a really big bubble that ensued too. And the internet's been a wonderful thing for the economy, and we wouldn't be having this meeting right now if it were not for that. And so I think it's of huge importance. It's going to be very interesting to see how everything plays out. But in terms of how to invest off of that, there's a lot of hype in that area right now. Any company that mentions they do it, the stock goes up right away. It's very similar to the .com in that sense, and also kind of reminds me of Bitcoin a few years ago, where everyone wants to talk about it. So we'll have to see. In terms of our process, it'll certainly help add a tailwind to the economy, I think, in terms of making it a lot, bringing down cost and removing certain jobs, and people will start doing other jobs. So I think, it'll be interesting to see how it all plays out, but that I don't have the answers, that's for sure, but looking forward to seeing what happens there.
I think it's right, Jim, because it's very similar to the internet. Whereas the internet stocks had discounted the hereafter by the year 2000, going through the 1990s. The internet was still important, but they got ahead of themselves by 5 or 7 years. I think you'll probably see the same thing. It hasn't happened yet, I don't think, with artificial intelligence. But before this thing is over, I think we will be in that position. And I think it's, when you look at the leadership in the stock market right now, it's technology, and it's just beginning. So I think there's going to be a growing speculative bubble in technology, perhaps not as strong as and as extreme as 2000, but definitely that's where one of the leaderships are right now.
Well, I'm all for artificial intelligence because I've been using natural stupidity my whole life. So if I can get any help from artificially, I'm all for it.
Awesome, Tom. I'm gonna leave that answer there. The next question was, everyone was saying a recession was coming. What happened to it?
Martin, answer that one.
There's always a recession. Just a question of when it arrives. If you look back at business cycle history, there's always a recession, but it doesn't have to happen every 4 years, because we get these slowdowns the growth slowdowns that take place. And that was one of the points I meant to mention in my my presentation, was that we're the down part of the business cycle right now, but I don't think it's a recession. I think there are certain sectors which are in recession or were in recession, such as housing and manufacturing. But things like employment are still holding up very reasonably strong, reasonably well. So I think the thing we have to worry about is a boring thing called the yield curve. Normally, short rates are below long rates because long rates involve a lot of uncertainty. So you need a higher interest rate to pay you for holding those instruments. But right now, short rates are above long rates. That's what they call a yield inversion. And when that happens, usually there is a recession. In fact, there's always been a recession, except in the last, since the 1950s or so. But the question is when it comes, and it doesn't have to happen immediately. It can come with a long lag. So even though I'm suggesting that we're recovering now and we're going to be okay for a while, that's one of the reasons for us not to be overly bullish on what's going on here, because further down the road, that tight money with a lagged effect that the Fed has had is going to affect the economy. So I don't think the recession is gone. There's always going to be another recession.
Right, that was,
Perfect.
I don't know if I have much to add to that, except it was the most widely predicted recession of all time, and that gave us second, thoughts that probably wouldn't happen right away, and because like the news doesn't fulfill itself right away, but it's probably been postponed. And as Martin was saying, a recession is where the entire economy takes a hit at the same time, and this time it's been just a few sectors that got hit, while other sectors like leisure and travel and such are booming. So more of a rolling recession hitting different industries at different times.
Great insight. Thank you, team. Next question. What would I need to do to set up a charitable fund? I think that's the donor advised fund. And Katie, would you like to answer that question?
You're muted, Katie.
Get there. Hi, everyone. Didn't get part of the presentation, but I'm happy to, wave to all our clients out there. If you would like a donor advised fund and set up something as charitable, you just need to call me. As always, we're going to do the paperwork for you to set up that account. It's very simple, an application just like any other. And also, when it comes time, once that's set up and you do have that funded, as far as withdrawals and making those withdrawals from those type of accounts, it is a different piece of paper than what you might have been used to if you've done QCDs and that sort of thing. But I'm going to help you through it. I'm going to do the paperwork for you. I'm going to process the withdrawal for you. And it is a really simple process. And if you would like to know more of the benefits, Pamela, I know, would be happy to go over more tax benefits for your situation. And she can literally make a really good advice on whether or not this would a product that would work for you. But as far as setting it up, we'll take care of it, and we'll walk you through the process just like we always have with any other type of account here at Pring Turner. So very easy. And Pamela, if you want to add anything to that, that's great. But we'll take care of you on both ends as far as, is this the product that will work well for you, and help you with the opening.
Awesome. That's perfect. Thanks, Kate. And yeah, it really is a really easy process in terms of, and if I misread or understood the question, what do I need to do to also get set up, is if you're wondering, is there an account minimum? Do you, what is required of you? Just so you know, the type of account that we would open up for our clients, you do not need, there is no account minimum. So you can open the fund and begin the account and begin funding it when it makes sense for your unique situation, which again, we're happy to talk to you about. So hopefully that'll help clarify if that was part of the question there. Excellent. Okay, I have several more questions coming in. So if we could maybe try and get through these in a quicker turnover, so just so we can answer as many in the time we have here. Next one coming in. Thank you for outlining your rationale concerning your recent investment in the 10-year T-bills. in effect lengthening the 5-year bond ladder previously established. Any additional comments on further additions to the bond ladder?
Great question. I'd say yes, we kind of dipped our toes in there with our first purchase. We're going to look, we do see it as an opportunity, as Joe outlined and Martin outlined, for where we are in the cycle. And we do expect to continue to lengthen out the bond ladder as the market, as we look at what's going on with the markets. We do expect to add more of those over time. Now, we probably won't, well, we'll see. We're not sure exactly what's going to happen. We don't have the expectation of probably holding those bonds to maturity. We probably will get to another point in the cycle where it might make sense to shorten maturities again. And we kind of go back to the shorter term bond ladder. But this is right now, the progression is to increase maturities given the current interest rate environment.
I would just add that, a year ago, we were starting that bond ladder, 1 year, 2 year, 3 year, 4 year, 5 year. And those 1 year ones are coming due here, some this month. So it gives us a chance to take that money and reinvest it out longer term. And we automatically get a higher interest rate from where we were a year ago. So that's the beauty of the ladder, is we have something coming due each year that we can take and reinvest at the current interest rates.
Great. Awesome. Thanks, team. I'm going to quickly do a popcorn style. I'm going to go back to the donor advised fund, and then I have another question about T-bills, because I can answer this question real quickly. Question on the Schwab donor advised fund: what are the typical fees you would be charged for managing it? And that's a great question, because there are two parts. You are required to have an administrator, meaning, for example, Charles Schwab Charitable as the administrator. And they charge 60 basis points, so 0.6% for the administration of a donor advised fund. Now, for us at Pring Turner, as this is a charitable component, it is an amazing opportunity for you for your own personal situation, but also we really support philanthropy. We do not bill on the donor advised funds that our clients have. So it is also a courtesy of our continued management for you. As those assets are already earmarked for charity, we will not bill on them. So it is only for the Schwab charitable fee at this time that would be relevant. So hopefully that helps clarify that question there. Thank you so much. The next question was, and I think you guys kind of started to touch base a little bit on it, but for the T-bills, if I can get 5% on a 3-month T-bill, why would I invest in a 3.5 or 4% bill in a 5 or 10 year period?
Okay, Joe, you want to try that?
Okay, so the question is, why would I take a 3-month T-bill paying 5? Is because there's a reinvestment risk, because in 3 months, what if we are in that recession, it showed up, and interest rates are lower? So now you would be reinvesting that money at lower interest rates. Given our bond barometer buy signal, we think that bonds are going to appreciate. So you put the combination together, you have reinvestment risk in short term and reinvesting that in 3 months. Whereas if you were to lock in, a 5-year bond, a 3-year bond, 5-year bond, and we do have price appreciation, as Jim pointed out in his example, you might be looking at an 11% total return versus your simple 5% return, and then having to reinvest that at a lower rate. So it's just a longer term, capturing longer term profit opportunity is why you would do that.
Very good.
Great. Yeah, that was pretty solid. Thanks, Joe.
Yeah, and that's also why we have a bond ladder. If rates go down, we'll still have locked in some money at different maturity dates, and as they come due, the cycle will turn. Rates can go down pretty fast, especially in a recession. So, we've got a strategy that will work as rates go down or as rates go up. We're going to take benefit from it.
Awesome. Wonderful. If anyone else has any other last minute questions, feel free to chime them in. I am currently at our last question right now, which is, looks like it's about the qualified charitable distributions. Would my RMD go to only one charity? So would my distribution only be allowed to go to one charity? And the answer is no. For QCDs, for qualified charitable distributions, you can choose to distribute and gift across several charities as you wish. Now you are limited. So for QCD, you're limited to 100,000 per year per person. So however you would choose to allocate those funds, whether you would, donate 1,000 or 100,000, you could spread that across multiple charities. You're not required to simply gift to one at a time. I hope that helps answer your question. I don't see any other coming in at this time, but for those who are still here, we would greatly appreciate if you would complete the survey and just, let us know your feedback so we can learn and always do better for you moving forward. Thank you so very much to all of you for joining us. We really appreciate it. You are the reason we show up every single day and thankfully have a lot of fun with what we do. So thank you so much, everyone. Thank you to the team, to Joe, to Martin, to Tom and Jim and Katie. Really appreciate you all, and we look forward to connecting with you soon.